Hi everybody, I hope you're having a good day. I sent out an email today regarding what to study for on the exam that takes place tomorrow. And as promised, I'm going to finish up problem 3-8B using the worksheets and the handouts that we didn't utilize so much in class yesterday. I'm going to pick this problem up from where I left off in the previous recording, which was after I completed the adjusted trial balance. All right, picking up from where we left off, we're going to start with requirement number 5 that says record adjusting entries. Depreciation for the year on the machinery is $8,000. Plumbing supplies remaining on hand at the end of the year, $1,100. Of the $10,000 paid in advance to customers, $7,000 of the work has been completed by the end of the year. I'm just going to keep recording adjusting entries on my regular general journal sheet, but I'm going to put adjusting entries down so that I'm aware that's what's taking place on these following entries. All of these are going to take place on December 31st. So you'll see the date there for 12/31. And the first thing they wanted us to was to record depreciation for the year on the machinery is $8,000. So that's that prepaid adjusting entry, except for since we're not allowed to directly mark down depreciable assets, we use that contra asset account, accumulated depreciation. I'm going to increase my expense, depreciation expense, with a debit of $8,000, and I'm going to credit that contra asset account, accumulated depreciation. For $8,000. So that's the first one of my adjusting entries. The second adjusting entry tells me that plumbing supplies remaining on hand at the end of the year equal $1,100. So what we're going to do is we're going to look over here at the T accounts, and you can see that my current balance in supplies is $3,500, and I need to have a corrected balance of $1,100 in that account. This means I have to adjust or decrease supplies by $2,400, and that's going to be the amount that we use for the journal entry, and it's the amount of the supplies expense. So on the journal entry, I'm going to debit supplies expense for $2,400, and I'm going to credit supplies for $2,400. So since I already partially started working on posting this journal entry, if we go back up to our T accounts and I want to post it, I had a debit of $3,500 debit. I'm going to post that credit that I just made in the adjusting entry, and now the corrected balance in the supplies account is $1,100. Additionally, I'm going to debit my supplies expense by the $2,400 in the expense account so I can record that on my income statement. And while we're at it, we can also post the depreciation expense and the accumulated depreciation journal entry. So I'm going to go to my depreciation expense. I'm going to debit $8,000 to the T account depreciation expense, and I'm going to credit $8,000 into the accumulated depreciation account. If I wanted to balance out now my accumulated depreciation account, it's going to have a balance of $16,000. All right, now there's the last adjusting entry that we have to do. Of the $10,000 paid in advance to customers, $7,000 of the work has been completed by the end of the year. So we want to record that $7,000 in revenue that we've earned, and we want to reduce the liability account unearned revenue. So I'm going to debit unearned revenue for $7,000, and I'm going to credit service revenue for $7,000. And then I'm going to post that to the T accounts also. I'm going to swap my T accounts so they're down here. I did a debit to unearned revenue, so I'm going to find that unearned revenue account on my T accounts. I'm going to put a $7,000 debit there, and then I'm going to go to service revenue, and I'm going to add the $7,000 here. So now we've done all of our adjusting journal entries and we've posted them all to the T account. So I'm going to check mark off my items here, make sure I've taken care of everything. And so they wanted us to record the adjusting journal entries, and then they tell us to prepare an adjusted trial balance, which means I have to come up with the new balances for any of the accounts that we adjusted. So we've already figured out supplies has a new balance of $11,000. Accumulated depreciation has a new balance of $16,000 credit. Unearned revenue has a new balance of $3,000. Common stock remains the same. Retained earnings, dividends are the same. Service revenue has a new balance of $92,000. And we also have a balance now in supplies expense of $2,400 and depreciation expense of $8,000. And these are the amounts that we're going to use when we prepare the adjusted trial balance. Now, I gave you guys the worksheet and I wanted to finish filling this out, and it's easier to do it on the video probably than in class. So last week when I initially recorded the first part of this problem, we filled in the unadjusted trial balance here, and you'll notice that the next two columns are marked for adjustments. So what accountants often do is they will make a note of the adjusting entries in these columns. For example, the first adjusting entry is a debit to depreciation expense and a credit to accumulated depreciation. I would go onto my trial balance, I'm going to find depreciation expense here. And under adjustments, I'm going to note that I had an $8,000 debit to that account. And I'm going to go up to accumulated depreciation, and I'm going to note that I had an $8,000 credit to that account. I'm also going to do that with supplies expense. I had a debit of $2,400. And then I had a credit or a reduction to the supplies asset account of $2,400. Then we have unearned revenue. I had a debit to the unearned revenue account of $7,000. And then I had a credit to service revenue of $7,000. So you'll see there I've got 3 debits, 3 credits, the same amounts, and those are just the amounts of my adjusting entries. So now when I go over to the third set of columns where it says adjusted trial balances, for the accounts that weren't impacted by the adjusting entries, I'm just going to transfer their prior balance over here. So cash will have a balance of $49,500. Accounts receivable still has a debit balance of $21,500. Supplies was adjusted. Originally, it had a debit balance of $3,500, but we reduced that with a credit for $2,400. So the new balance in that account is $1,100. Equipment didn't have a change, $36,000 debit. Accumulated depreciation, we increased. We started out with an $8,000 credit balance. We add an additional credit of $8,000 to that account. So the new credit balance in that account is $16,000. Accounts payable is still a $6,000 credit balance. Utilities payable is still 0. Unearned revenue has been reduced from $10,000 to $3,000. So we've got a $3,000 credit balance in unearned revenue. Common stock is $34,000. Retained earnings is $9,500. Dividends is $3,000 debit. So service revenue is $92,000. That's that increase of $7,000. Salaries expense is $33,000 debit. Utilities expense is $6,000 debit. We show we now have a balance of $2,400 debit in supplies expense and $8,000 in depreciation expense. So if you were to total those columns up, you would come to a total of $160,500. So let me do that. $160,500. $160,500. All right, now that we've done our adjusted trial balance, now we need to prepare the income statement for 2015 and the classified balance sheet for December 31st. I wanted to point out before we start doing that, there's 2 other columns left here, one for the income statement and one for the balance sheet. And so what accountants do, they're utilizing worksheets, is they'll move the accounts over that impact each of the statements. So we've got service revenue has that credit balance of $92,000. That goes on our income statement. And then The salaries expense is going to be on the income statement. The utilities expense is on the income statement. The supplies expense is on the income statement. The depreciation expense is on the income statement. And then we can also move over all of the balance sheet accounts into the balance sheet columns. So cash is going to be $49,500. That's on the balance sheet. $21,500 for accounts receivable is on the balance sheet. The $1,100 debit balance for supplies is on the balance sheet. $36,000 debit balance for the equipment will go on the balance sheet. In addition to that $16,000 of accumulated depreciation, that's a credit. Accounts payable goes onto the balance sheet. Utilities payable, there's a zero balance. But remember I said yesterday, since it's a permanent account, we keep it we show that we have that account even with a zero balance. Unearned revenue has a $3,000 credit balance. And then common stock has a $34,000 credit balance. And I'm going to leave that there for right now because we're going to have to make an adjustment to that retained earnings on the balance sheet at a later point. So I'm going to go move things around just a little bit. And remember, we're going to use the unadjusted trial balance to help us prepare the financial statements. And every financial statement that we work on has that heading. So we're going to do the income statement first. We always start with the name of the company at the top, Piper's Plumbing in this case. We put the name of the statement, income statement, and then the income statement covers a period of time. So in this case, it's a year, so we're going to put for the year ended December 31st, 2015. So if you think you might be worried about forgetting how to do a heading on the test, write this down on your card. That's okay to have there. So again, we're going to start with all the items for the income statement, which are these items here that I transferred over to the income statement column. We always start off with revenue first. We have one revenue account, service revenue. That's $92,000. And then I've got four expenses that come next. I've got salaries expense. That's $33,000. I have utilities expense. That's $6,000. I'm getting a little bit of a shadow on here, so I'm trying to move back a little bit so that there's not as much shadow on your paper. So we've got utilities expense. Now we've got supplies expense of $2,400. And then depreciation expense of $8,000. We're going to put a line under that column of numbers and give us a total expense amount. Our total expenses are $49,400. And now I can calculate out net income. Because my expenses are less than my revenue, I'm going to have net income rather than a net loss. And in this situation, net income comes to $42,600. And if you want to, you can put that amount here on your net income. And you can just put it there for $42,600. So that's all you need to do for your income statement. The problem and the exam doesn't require you to do a statement of stockholders' equity. So this problem wants you now to do the balance sheet. So we're going to do the balance sheet. Remember, we have to put on our heading, Piper's Plumbing. The name of the statement, it's the balance sheet. And the balance sheet's only good for a specific day because a lot of these account balances change on a daily basis. So it's just the last day of the accounting period. So December 31st, 2015. We always start with assets. And when you get the adjusted trial balance that you're going to use on the test, you can just go in the order that the assets are listed here on the adjusted trial balance. We do them in order of liquidity, and we split them up between the current assets and those non-current assets, current liabilities and non-current liabilities. So here we've got 3 current assets. We have the cash. That's our most liquid asset, obviously, since it's already cash. We have accounts receivable, $21,500. And then we have supplies of $1,100. So our total current assets are going to be $72,100. You know me, I never give enough room for me to write everything down. $72,100. And then I've got that depreciable asset equipment, and GAAP requires that I record any of these depreciable assets at their historical cost. So the cost of the equipment was $36,000, and from that I'm going to subtract the accumulated depreciation of $16,000, which means I'm really only adding in $20,000 of that equipment cost into total assets. So to arrive at the amount for total assets, I'm going to add up the $72,100 to the $36,000, and then I'm going to subtract $16,000, and I'm going to arrive at a total asset amount of $92,100. Remember, it's the balance sheet, so if total assets are $92,100, then total liabilities and stockholders' equity also needs to equal $92,100. So when we go to the next side, we have liabilities. We'll look on our adjusted trial balance. We've got accounts payable of $6,000 and unearned revenue of $3,000. We show the utilities payable on the trial balances, but we don't need to include zero account balances on our financial statements. So I'm going to have accounts payable of $6,000 and unearned revenue of $3,000. And because we don't have any other liabilities, I would just put total liabilities. You don't have to split them up between current and long-term if you only have one type. So our total liabilities are $9,000, and that leaves us with the 2 components of stockholders' equity. We have common stock, and common stock is $34,000. And then we have retained earnings. And remember, I didn't include that on the balance sheet over here because the retained earnings amount that's going to go on the balance sheet needs to be adjusted for net income or dividends, anything like that. So I'm going to write down here, I'm going to show you how we're going to calculate out the correct amount for retained earnings. We always start out with the beginning amount in retained earnings that we get off the adjusted trial balance. So we have beginning retained earnings of $9,500. Then we add the net income that we calculated up here of $42,600. And then we subtract any dividends. And to find out if there's dividends, we look on the adjusted trial balance and we see that we have $3,000 in dividends. So we're going to subtract those out, and that's going to give us ending retained earnings. And the balance in ending retained earnings is $49,100. It's going to go right here, $49,100. I could put it over here now if I wanted to under retained earnings, $49,100. And then, so I'm going to add up the common stock and the retained earnings. That's going to give me total equity of $83,100. And then I'm going to add total liabilities and equity together. That's the $9,000 plus the $83,100. and I'm going to arrive at $92,100, which means that my balance sheet balances, and we've done it correctly. All right, everyone, we're almost done. This is a long, long problem, but I wanted to go through the whole thing so you can see how everything works. We're on step 9 now, which is to record the closing entries. Remember that we talked in class yesterday about how we want to close out all those accounts that only give us information for the year. So that's revenue, expenses, and dividends. We want to have those start over every year because we want to keep track of the revenue for the year. We don't want to know how much revenue the company's made since the beginning of time. That's what the retained earnings accounts are for. So that means that we're going to close out all of the accounts that are on the income statement as well as the dividends accounts. And we're going to bring those balances down to 0. And that at the same time, we're going to update retained earnings. So when we're finished, the correct amount balance in retained earnings will be $49,100. Remember, currently it's sitting at $9,500. So I'm going to start here with my T accounts because that's really one of the best ways to go through this illustration. I already have I have a credit balance in service revenue, and I need to have a 0 balance. So in order for me to arrive at a 0 balance, I need to debit service revenue by $92,000, and at the same time, I'm going to credit retained earnings by $92,000. So my first closing entry, December 31st, I'm going to debit service revenue for $92,000, and I'm going to credit retained earnings by $92,000. And if you remember way back at the beginning of the semester when we were doing the accounting equation formulas, I would go, what does revenue do to retained earnings? And we would talk about increasing it. Well, here's where you actually see it happen. I'm going to post this debit of $92,000 to service revenue. So now I have a 0 account balance in service revenue. And I'm going to post this credit to retained earnings. So I've added $92,000 to retained earnings. So pretty easy step there. The second step is to close out all of our expense accounts. Expense accounts have normal debit balances, and so we need to credit all of those accounts. And so we'll credit all the expense accounts by their balances to bring them to 0, and we're going to debit retained earnings for the amount of the total expenses. So retained earnings is going to get a debit of $49,400, and then salaries expense will be credited $33,000, utilities expense $6,000, supplies expense $2,400, and depreciation expense of $8,000. So I go to post this to the accounts. I'm going to enter a credit of debit onto retained earnings, reducing it at $49,500. I'm going to credit salaries expense by $33,000, which gives me a 0 balance in that account. I'm going to credit utilities expense by $6,000, which gives me a 0 balance there. I'm going to credit supplies expense $2,400, which gives me a 0 balance there. And I'm going to credit depreciation expense by $8,000, which gives me a 0 balance there. So I'm almost all the way there. My service revenue is a 0 account balance, and all of my expenses are now down to 0. So the last temporary account that I have is dividends. And remember, we also talked about how dividends reduces retained earnings. So in order to close this out on December 31st, I'm going to debit retained earnings, which is going to reduce the retained earnings account by $3,000, and I'm going to credit dividends for $3,000. Then when I post this, let me mark that I posted all of this. When I post this, I'm going to enter $3,000 onto the debit side of the retained earnings account, and I'm going to put a credit of $3,000 to the dividends account and zero that account out. And so now my retained earnings has to be calculated, the new balance. So I'm going to have 9,500 plus 92,000 minus 49,500 minus 3,000 is going to give me a credit balance in retained earnings of $49,100, which is the correct amount that we have here and that we've shown in our balance sheet. And now we've brought all of our accounts up to date. So there's one last step, and my fingers are tired, so I'm going to show you the solution. The last step is to do a post-closing trial balance with the account balances, with all of the permanent accounts on them. So I want to go over this with you just quickly for a moment. So you'll notice, again, all of the accounts from dividends, service revenue, salaries expense, utilities expense, supplies expense, and depreciation, they are all zeroed out. They won't go on that post-closing trial balance. Only the permanent accounts will. And so you see it's listed here. We have the name of the company, the name of the trial balance, and the date. Again, all trial balances are just a list of the company's account balances and their debits, whether they're debits or credit. So for this post-closing trial balance, cash has a debit balance of $49,500. Accounts receivable has a $21,500 debit balance. Supplies has a $1,100 debit balance. Equipment has that $36,000 debit balance. Accumulated depreciation, $16,000 credit balance. Accounts payable, a $6,000 credit balance. Utilities payable, because it's a permanent account, we're going to show it as a zero balance. Unearned revenue has a $3,000 credit balance. Common stock has the $34,000 credit balance. And then retained earnings has $49,100 credit balance. So once you've completed your post-closing trial balance, then you're ready to start the entire process over again from start to finish. So what we do as accounting is we do this over and over and over again. So just as a really quick recap, step one, we did our general journal entries that took place all throughout the year. We posted those to the T accounts. Once we balanced out our T accounts the first time, we created the unadjusted trial balance. At that point, we were able to do our adjusting entries that take place on the last day of the month typically. We then updated the balances in the T accounts impacted, and we're able to do the adjusted trial balance. We have the adjusted trial balance, which allows us to do the financial statements, which we did over here, where we did the income statement and the balance sheet. We're then required to do the closing entries to close out all of our temporary accounts. Again, we go to the T accounts and update them. And the last step is to do that post-closing trial balance, and we're ready to start the accounting cycle again. All right, you guys should be really proud of yourself. It's a lot of hard work.